You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Investors experienced a bit of information overload this week, but despite all of the economic news that came out, the three main events they were locked in on were midterm elections, the Fed's announcement of another round of stimulus, and Friday's jobs numbers. Overall, stocks turned in a much higher week, with the market showing its approval of the Fed buying $600 billion in U.S. bonds through the middle of next year by shooting to its highest finish in 2 years at midweek, which brought the Dow back to the level it was prior to the Lehman Brothers collapse. And it was reported on Friday that the economy picked up 151,000 jobs last month as private companies hired workers at the fastest pace since April, offering yet another sign of a pickup in the sluggish economy. We're going to bring Steve Reitmeister, our editor-at-large, back in here now to chat with us for a while. So overall, with the jobs news that came out on Friday, we've seen strong corporate earnings on the aggregate, news of an improved economy, and albeit slowly, and more quantitative easing. So do you feel here that the underlying fundamentals in the market are still positive going into year's end?
Yeah, absolutely. And this is no shock to anyone who's been watching this show for a while and how we have felt that for most of us, we believed in a modestly improving economy and not giving into the fears of double dips. So yes, we do see some positive signs. And so after what was a fairly lackluster second quarter as far as GDP growth, we see it come up a notch in the third quarter. And now we see more signs, that last piece that we want, which is unemployment, we start to see that coming maybe into shape with this very nice October report.
Yeah. It seems like some pretty positive earnings momentum has been built up here overall. Do you look for that to continue going forward?
Yeah, what you want to see coming out of a recession is a improving economy. Now, at first, all the corporations, they cut all their costs, and so at first there's really no sales growth. They're just making better profits because of the lowered cost of slashing employees and squeezing vendors and things of that nature. But now, which is what's supposed to happen, is that the stronger corporate profits leads to more money in people's pockets, leads towards more spending, and then a little more jobs, and then it's this positive cycle which creates positive earnings momentum within the economy. It's all these natural positive cycles of growth taking place. Now, not as fast as some might like, but it's growth nonetheless. And so we get further and further away from this double dip scenario.
Okay. You recently wrote an article on earnings momentum pertaining to individual stocks as well.
Sure did.
And share with us a little bit of your weekend wisdom on how powerful earnings momentum can actually be for individual stocks.
Sure. One of the ways I try to take a look at that picture is at the end of every year, places like the Wall Street Journal and Money Magazine, they'll have a list of the top performing stocks for the year. That list of stocks, there is one thing they have in common, which is they have positive earnings momentum. It doesn't mean that each of them had the highest earnings growth year over year. These are the folks that had the earnings growth that was much higher than people expected, meaning a company that was expected to grow at 10% a year and ended up growing twice as fast at 20% a year will do a lot better than a company that was expected to grow at 40% a year and came in at 30%. It is all about beating expectations, and that's the kind of positive earnings momentum, that something is going on very right within these firms that will continue going right into the future, meaning the right management team, the right product mix, the right employees, the right marketing programs, and so on and so forth, and it has this positive momentum that carries on quarter after quarter, earnings surprise after earnings surprise, increase in stock price, and so on.
All right,
that is the power.
Here's the $64,000 question.
Okay.
How does one go about finding these individual stocks with positive earnings momentum?
The work of Len Zacks has been very powerful in that some of the research that he has done in the past to find companies that are more likely to have positive earnings surprises, and other academics have joined in on this movement as well. So a company that is more likely to surprise has positive estimate revisions going into their earnings report, meaning that the analysts from the brokerage firms who follow these stocks, they see that something positive is going on there. They raise their estimates. The company is more likely to have an earnings surprise, and then repeat this cycle, kind of rinse and repeat. And this was where you get quarter after quarter of a stock outperforming its expectations and having phenomenal share price increase.
I like that. Rinse and repeat.
Rinse and repeat.
I'm going to have to jot that down.
Yeah. I overdid it on my own head there.
The docket is kind of light on economic. I'm not going to comment on that. Don't worry. I can identify with that. Docket's kind of light on economic news in the week ahead. Kind of pales by comparison to this previous week. What's on your radar? Yeah,
there really is no big report out next week. And so what I recently wrote in one of my commentaries is the trend is your friend. So if there's not much news out there, then what has been going on recently as far as whether it be GDP, earnings, unemployment numbers, all fairly positive, that the bias is towards the upside. I think no news is good news.
All right. And bonds might be on the way down quickly?
Bond prices, but bond rates are going up, and a person can profit from that by shorting the bonds with TBF or TBT.
Okay. You're back at the roundtable. We'll see you with more still ahead. Here is your Bull and Bear Stock of the Week. Very popular staffing company and a specialty retailer. Top this week's Bull and Bear of the Week list. Shiraz Mian, our research director, here with us once again to fill us in on both of those choices. The staffing company, if you haven't guessed by now, is Manpower, MAN, the ticker symbol, on the New York. And not too hard to see why this would be a Bull of the Week.
Yes, that's true. This environment that we are in, where the economy has been growing, the earnings outlook for the corporate sector has been good, but the labor market still remains sluggish. It's kind of the sweet spot for a company like Manpower. And folks would be surprised that Manpower is not a U.S.-centric company. I
would be surprised it's not.
It's not. The bulk of their revenue and earnings come from outside the U.S. About 30% come from France. Another 35-40% come from the rest of Europe. The U.S. is about 10-15% of the total mix. In Asia is a growing part of the pie. So it's two main reasons for why we pick this up. Number one, the continuous reliance from the corporate side on the temp hirings.
Right.
And the temp hiring and those types of recruitment have been the strength in the economy lately. And that trend is expected to continue over the coming quarters and maybe a couple of years. Okay. And Manpower is the main player in that segment. About 50% of the end markets are like these light industrials. Another 10-15% are the clerical temporary positions. So that's the main reasons for them. They're also growing very fast. They have very strong plans for Asia. Their balance sheet is in excellent shape.
It's an interesting statistic about them. I didn't know that.
Yeah, no, it's a global player and a global play on the labor market. So very well positioned. They had a blowout Q2. The outlook for the earnings is very, very good. We are seeing very strong positive estimate revisions for the final quarter of the year and also for 2011. And my sense is that that trend will continue.
Okay. PetMed Express, PETS, ticker symbol on the NASDAQ, is this week's bear. Why?
This is the other side of the same argument that I mentioned about the continuing lackluster labor market. It weighs on the consumer, and when the consumer is stressed out, he or she tries to cut back on some of those discretionary items that they could reduce. So PetMed.
Pets have become a discretionary item.
Pets, taking the over-the-counter and prescription medications, folks try to get those medications filled at discounters, at outlets where they could get a relatively better price, and it's affecting these guys. They would spend heavily on acquiring new customers. That has been the mainstay of their business. In fact, their customer acquisition costs are about 35-40% higher than it had been around this time last year. The revenue position is weak. the cost position is increasing, and that's squeezing their margins, and that's showing up in the earnings. They had a very weak Q2, which was surprising because their first quarter was even weaker than that. Estimates are coming down.
Okay. All right. Thanks a lot for that. We're screening for stocks next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. This week we're talking about current ratio, whatever that means, but we'll get an explanation, I'm sure, from Kevin Matris, our top stock screener, who's with us once again. Seems to me that we did this once before, but it has been a while, so even I need to have my memory refreshed, and that's not just because of my age this time. What is current ratio? What is current ratio?
The current ratio is simply another item to really help gauge a company's financial health. So let's take a look at the definition.
All right.
First off, current ratio is current assets divided by current liabilities. So the higher the ratio, the better, meaning the company has more liquid assets to meet its short-term obligations.
All right.
A ratio of 2 or more, for example, means a company has at least twice as many short-term assets than short-term liabilities, and that is generally considered good. Now, if you were to look at the current ratio for the stocks in the S&P presently, the average current ratio is 1.82. If you were to look at which sector has the best current ratio, the medical sector, they currently have the best current ratio. They have a median of 2.68. Finance, though, has been dragging at the bottom for the last couple of years. Their current ratio is at 0.96. But this does illustrate that there can be quite a diverse range of current ratios based on what sector or industry you're in.
All right, so how would you use this current ratio?
Well, screening for it is quite easy. You know, as we said, it is a ratio. So really on any screener out there, whether it be ours or somebody else's screener, the first thing you're going to want to do is you're going to want to go to the ratios category. From there, you'll go to the liquidity and coverage section. And then once you're in that section, you'll see an item called current ratio, and that's the one. Now, the way I prefer to use it is I like to compare a stock's current ratio to the median for its industry, and I think that is the best and most appropriate way to apply this item.
Yeah, it would seem to be. Is that how you're using it in the screen this week?
Yeah, we're looking at current ratios that are greater than the median for their industry, and we're also applying a bunch of other solid items to help flesh this screen out. So check it out.
All right.
We start off by looking at companies with an average broker rating of 1, so only strong buys are getting through. Then we want the current ratio to be greater than the median for its respective industry. So again, we want companies with the strongest liquid positions to meet their short-term obligations. And for this one too, we want to make sure the current ratio is still above 2. So at the very least, we want companies to exceed the commonly held definition of good. Then we want the projected 1-year growth rate to be greater than the median for its industry. We want the projected 1-year growth rate to at least be greater than 0, so it has to be positive. And then all of these things are being applied to companies with a price greater than 5 and a volume of greater than 100,000 shares or better. Okay,
quickly, some stocks that have come through the screen.
Yeah, there was about 30 that came through. Here's 5. We have Buckeye Technologies, Boise Incorporated, CN Insure, iGate Corp, and STR Holdings. A very diverse set of companies, but all of them look very, very strong financially.
Yeah, it is a very diverse set of companies. And that's really on these screens, you strive to get as diverse a set of stocks as possible?
You know, sometimes I specifically look for that, but sometimes it just happens to turn out that way, especially if you're looking for the best companies, because there's really only a couple of handful of top companies in each sector, and they're going to pop through when you're setting up a screen like this.
Okay, well, we appreciate you taking the time to explain current ratio to us.
Right.
I hope that you've learned something from it. Kevin's back with us on the roundtable. That's up next. We'd like you to stick around for that, as there's more still ahead. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Jobs numbers, the stock market, and QE2 all on our agenda this week. And we're going to be talking about that with our editor-at-large, Steve Reitmeister, the able-bodied research director, Shiraz Mian, and top market technician, Kevin Matris, all here at the round table. Shiraz, I'm going to start with you because I want to talk about this jobs report that came out on Friday morning. Positive news, picking up 151,000 jobs in October, positive revisions to other September and October data as well. Can we take this as a solid sign here that there's going to be some firm growth going forward in the economy?
If we sustain what we got today in the coming months, then a resounding yes. Because what we got both on the headline as well as the internals is about as good as any of us could have wished for. So on the headline, we beat the expectations. The prior 2 months, which were extremely bad, were revised upwards, and if we had seen those in those months, we would have been very happy. Right. On top of that, the average work week increased, the average hourly earnings increased, and we had pretty solid temp job creations in October as well. So if this trend sustains into November and December, we may have the makings of a pretty decent turnaround in the labor market. It'll still take a while to reduce the mountain of the unemployment numbers that we have created during the downturn, but a very solid start if it can be sustained over the coming months.
Okay, so we're going to move forward with some cautious optimism. We're not going to get overexcited yet, but I heard you make a statement when you walked into the studio that the market's on a sugar high here. So, Kevin, with that in mind, is the market, with all the news that came out this week, is the market getting a little bit ahead of itself here in its euphoria?
Yeah, I don't think it is. Maybe it is on a sugar high, but I think this high can last for a while. If you were to look at the report, the jobs growth came in twice as good, more than twice as good as expected. You even saw job increases in construction. Who knew when that was ever going to see some signs of life, and it finally did. So, I think everything looks good. And what's interesting is I saw this before I came down here. If you were to look at a chart of the non-farm payrolls, it really does look like a V-shaped recovery, or at least a sharp U. And we are definitely heading into the right direction, and we're finally now seeing real growth. As for the market, we've said this numerous times. I thought that if we got through 11.5 and 11.7, I thought we had the ability of getting to 12.2 or 12.5. I really do think 12,000 is a realistic target for the end of the year, and I would not be surprised to see us even break through 12,000 and get to that 12.2 area. I think there's a lot more movement ahead.
All right. Steve, QE2 is what sparked the euphoria or added to the euphoria this week in the market. You think we're really going to see this help spur some solid economic growth here?
I think that it was unnecessary, but it's not going to do so much either. So I don't think it's going to do so much good. It's not going to do so much bad, and it just kind of adds to the general story. So the positive story is that I do think we have a solid turnaround in the economy. We see this in the earnings growth so far.
Right.
Finally, that last piece coming together is the jobs picture, or we hope it's coming together. You first got to make a positive step before you can make some really extreme steps, and so this seems to be going the right direction. So QE2, I thought it was unnecessary. I thought they were bluffing. Actually, I thought they were just talking down rates, and they're going to say, "Hey, it's not needed." So whatever, they came out with it. Actually, I think that's one of the non-stories going on. We have an economic recovery, positive earnings growth, and reasonable valuations for stocks. Good, good, good.
I heard somebody say that this is an economy of baby steps. You still agree with that? Because you had said way back that we need to take small steps before we can take the larger steps.
Right. Baby steps, yeah, because it's a slow growth, moderate growth recovery, which is fine. Here again, it's not a double dip. Right. It's not a V shape. So baby steps is an interesting way of putting what it means to have moderate, steady growth.
Okay. Anybody want to venture a guess on QE3?
I would just add a little bit, adding to what Steve mentioned. I think it was needed. Needed in the sense that it buys the U.S. economy an insurance policy against deflation and against a double dip. And some of the positive momentum that we saw in the market over the last 2 months was, in fact, reflective of that.
Okay, Kevin?
I do want to say I do think QE2 is getting a little bit more credit than it deserves. You know, the dollar has been falling precipitously for quite some time. It's been in a protracted downtrend. You could see that the dollar really started to resume that downtrend over the last couple of months, and the stock market was rising in perfect inverse tandem with it. Now, you could argue that the dollar was falling in anticipation of QE2, but like Steve, I think even if they didn't do any QE2 easing, I still think the dollar was headed lower, and I think it's going to continue to head lower.
All right, Steve, give us your top stock pick of the week.
I'm going to go with Eastman Chemical. This is a chemicals company, as the name implies. And just like a lot of other natural resources plays, with the emerging markets doing so well, the BRIC nations and our own economy recovering, a lot of resources will be eaten up, and that includes chemicals. They pre-announced strong earnings. They saved a little bit of powder to have a positive surprise, and estimates going higher. They sold off a division of their company for $200 million than everyone thought they would. Great dividend. It's just a solid, great growth story.
All right, Shiraz?
In the spirit of the sugar high that I mentioned earlier, I'll give a sugary name, Krispy Kreme Donuts.
Okay.
This company had fallen on hard times a few years back. New management team came in. They refurbished the strategy, and they are executing the strategy impressively. Growth is back. The momentum is back. They had solid quarterly results, and the estimates are on the up. But we think it's a good call.
Kevin, quickly, how do you compete with that?
Discover Financial Services, no sugar there, but ticker symbol is DFS. They're in the financial services industry. They do credit card services, direct banking, all sorts of stuff across the country. They are a top-ranked stock. They're in a top-ranked industry. Finances are really on the move. They just reported earnings. Actually, not just, but they reported about a month ago, and they produced a 34% positive EPS surprise. They have earnings estimate revisions across the board. I think DFS has at least a 60% upside potential. How about that? 60. I said it.
Making Steve think here.
I got to take a look at that.
Thanks for being with us. We're going to have to leave it right there. Thank you for being with us this week as well on Profit from the Pros. Hope the week ahead for you is a profitable one.